Hello, and welcome to HouseLux Estate, your trusted source for all things finance and investment. This is where you can stay ahead of the curve, gaining insights into the intricate world of investing, real estate, and personal finance. By subscribing to our channel, you're not just a passive viewer, but an active participant in a community of savvy investors. Today, we delve into an interesting topic: the relationship between gold prices and stock market trends. Before we get into the relationship, let's first understand the individual concepts of gold prices and the stock market. Gold prices, a critical element in the global economy, are determined by a variety of factors. Supply and demand play a significant role, with increased demand and limited supply leading to higher prices. Besides, global political and economic stability, inflation, and currency fluctuations also contribute to the fluctuation in gold prices. For centuries, gold has been a safe haven for investors, a tangible asset that retains its value over time, even in the face of economic uncertainty. Now, let's shift gears and talk about the stock market. The stock market is a virtual or physical marketplace where buyers and sellers trade shares of publicly held companies. Each share represents a piece of ownership in a company, and the price of these shares fluctuates based on various factors, including the company's financial health, economic indicators, and overall market sentiment. The stock market holds great significance in our economy. It is a barometer of a country's economic health and a place where businesses raise capital for expansion and growth. It's also a place where investors, from individuals to large institutions, can grow their wealth by investing in these businesses. How does it operate? Well, it's like an auction house. It facilitates the buying and selling of securities, matching buyers with sellers. When a company decides to raise funds by selling shares, it lists on the stock market. Investors then buy these shares, betting on the company's future performance. If the company does well, the price of its shares rises, and investors make a profit. But remember, the stock market is not a one-way street to riches. It carries risks. Prices can go down as well as up, and investors can lose money if a company underperforms or if wider economic conditions are unfavorable. Now that we understand these concepts, we can explore how they relate. Historical trends provide key insights into the relationship between gold prices and stock market trends. As we dive into the annals of economic history, the dance between gold prices and stock market trends becomes more visible. Let's start with the Great Depression in the early 1930s. During this period, the stock market crashed and investors flocked to gold, causing its price to skyrocket. It was a clear demonstration of gold's status as a safe haven in times of economic turmoil. Fast forward to the 1970s. The United States was in the throes of an economic crisis with soaring inflation and a stagnant economy, a situation often referred to as stagflation. Gold prices again surged as investors sought a shield against the eroding value of fiat currency. Then there is the financial crisis of 2008, which saw the stock market take a nosedive. Gold prices? They went through the roof. Investors, spooked by the tumbling stocks, turned to gold as their safety net. The yellow metal's price rose from around $600 an ounce at the start of the year to over $1,000 by its end. On the flip side, during periods of economic stability and growth, the stock market tends to flourish while gold prices often stagnate or even fall. The 90s and the mid-2000s were characterized by such trends, with booming stock markets and falling gold prices. These historical trends highlight a pattern, a kind of push and pull between gold prices and stock market trends. In times of economic uncertainty and turmoil, gold often shines bright, its price soaring as investors seek a safe haven. Conversely, in times of economic stability and growth, stocks typically outshine gold, which tends to lose its luster. However, this isn't always a hard and fast rule. There have been periods of divergence and convergence between gold prices and stock market trends. The factors influencing this relationship are complex and multifaceted, including everything from geopolitical events to changes in monetary policy. History has shown a clear relationship, but what does this mean for investors? More often than not, gold prices and stock market trends have an inverse relationship. Now let's dive into what this inverse relationship entails. Imagine a seesaw. When one side goes up, the other side goes down. This is precisely the kind of relationship gold prices and stock markets tend to have. When the stock market is on a bull run, investors are confident. They are willing to take more risks and often opt for equities over gold, causing gold prices to dip. On the other hand, when stock markets are plummeting, there's panic in the air. Investors start seeking safer havens for their money, and gold is often their first choice. It's seen as a solid, reliable store of value that can weather economic storms. As a result, gold prices tend to rise when stock markets are falling. But why does this inverse relationship exist? Well, it primarily boils down to investor sentiment and perception of risk. Stocks are viewed as riskier investments that offer potentially higher returns, while gold is seen as a more stable, albeit less lucrative asset. So when the economy is doing well, investors feel comfortable taking on more risk, hence the preference for stocks. Conversely, when the economic outlook is gloomy, the perceived safety of gold becomes more attractive. It's important to note that this inverse relationship doesn't always hold true. There are periods when both gold prices and stock markets rise or fall together. However, historically, the overall trend has shown an inverse relationship. So, what does this mean for you as an investor? This inverse relationship between gold prices and stock market trends offers a unique opportunity for diversification. By investing in both stocks and gold, you can potentially balance out your portfolio. When stocks are doing well, your equity investments may thrive, and when they're not, your gold investments can provide a safety net. This inverse relationship offers unique opportunities for diversification and risk management. It's like having a financial seesaw that's always aiming for balance, regardless of market conditions. Understanding the relationship between gold prices and stock market trends can inform strategic investment decisions. Let's delve into how this knowledge can serve as a valuable tool for investors. Diversification is the cornerstone of a robust investment strategy. By investing in a variety of assets, investors can spread their risk. Think about it as not putting all your eggs in one basket. If the stock market takes a tumble, having a portion of your wealth in gold can help cushion the blow. This is because gold often moves inversely to stock markets. When stocks are down, gold prices tend to rise. Now let's consider an example. Imagine you have a portfolio that is heavily invested in technology stocks. As we know, this sector can be volatile. To manage this risk, you could allocate a portion of your portfolio to gold. That way, if tech stocks dip, the potential rise in gold prices could offset some of the losses. But how much should you invest in gold? While there's no one-size-fits-all answer, financial advisors often recommend a gold allocation of around 5 to 10% of your total portfolio. Remember, the goal is not to strike it rich with gold, but to provide a safety net against market volatility. Another strategy is to use gold as a hedge against inflation. The theory is simple. When inflation rises, the purchasing power of currency falls, but the value of gold tends to hold steady or even increase. Thus, holding gold can safeguard your wealth during times of economic instability. However, like all investment strategies, these are not without risks. The price of gold can be just as unpredictable as the stock market. Therefore, it's crucial to regularly review and adjust your investment portfolio based on current market conditions and your financial goals. In conclusion, understanding the relationship between gold prices and the stock market can help in making strategic investment decisions. By diversifying your portfolio and using gold as a hedge, it's possible to maximize returns and minimize risk. Strategic investment decisions can maximize returns and minimize risk. In summary, there is a significant relationship between gold prices and stock market trends that investors should keep in mind. This intricate dance of economic factors is not just a fancy financial theory. It's a real-world tool that can help you make strategic investment decisions. Let's take a quick jog down memory lane. We've discussed the historical trends of gold prices and the stock market, highlighting the inverse relationship that often exists between them. When stock markets are bullish, gold prices often bear the brunt, and vice versa. This inverse relationship provides a safety net for investors, a way to balance the scales when one side seems to tip too much. Understanding this relationship is more than academic knowledge. It's a compass guiding you through the choppy waters of investment. It's a lighthouse showing you the safe shores amidst the stormy seas of economic uncertainty. But remember, every investor's journey is unique. While gold and stocks have their dance, your investment decisions should also consider your personal financial goals, risk tolerance, and time horizon. The world of investment is a grand orchestra, and you're the conductor, with gold and stocks being two of the many instruments at your disposal. How you direct them determines the music of your financial success. Thanks for watching. Don't forget to like this video, share it with your friends, and hit subscribe for more insightful content from House Lux Estate.